Good morning. In the last class, we have discussed some accounting standards. Now, remaining accounting standards we are going now at present. And the, today we are going from accounting standard 14, that is accounting for amalgamations. You see, when a company, when it is doing a business, and when you come across a competitor doing the same business, automatically you will come across competition among the two companies, and no one will get any benefit or profit amount. They cannot catch hold of the market demand. They don't have many customers. So whenever they compete with each other, automatically that competition will go to a cutthroat competition, and it is not good for any person. So that's why, in order to capture the whole market and in order to eliminate the competition, two or more companies, they'll come together and they will form a new company, and that thing, we'll call that thing as amalgamation. The two or more companies who are combining together, we'll call them as amalgamated companies, and the new company, we'll call that thing as amalgamating company. When we do this, when we go for this, automatically we will come across a market, a unique market demand, and you will see a unique price in the market. There won't be any cutthroat competition among the companies, because these two companies, they form into a new company, and that company will distribute all the goods whatever the companies they want to sell. So like this, in order to eliminate the cutthroat competition and in order to capture the whole market, we will come across amalgamations. And there is one more type in amalgamations, that is nothing but absorption. That is, one company will absorb another company. Here, if you want a detailed thing, we'll discuss this in the next classes. And just a small example that I'm going to quote. See, we are having refrigeration companies. We are having refrigeration companies with us, and that is Alvin Company and Voltas Company. And this Alvin Company, it was absorbed by Voltas Company. And why this Alvin Company was absorbed by Voltas Company? Taking into account the misappropriations and mismanagement in Alvin Company, it cannot able to get the benefit what it expected. So in order to get this, in order to get out of this, it want to sell its business. And Voltas Company, it absorbed this, Alvin Company, and that thing, we'll call that thing as absorption. In this, one company will absorb another company into its business. So that is also one of the important amalgamation topics that we come across. This is about accounting standard 14. Now we are going for accounting for retirement benefits in the financial statement of employees. When we come across this retirement benefits, we have to take into account the employees and what benefits we are giving to the employees after their retirement, like PF, gratuity, all these things, they will come into existence. They have to be paid the salary, they have to be paid the gratuity, they have to be paid the PF, and if not, in some companies, they are going to pay the pensions. All these things, how we are going to show that in the financial statements. All the retirement benefits given to employees, how we have to show that in the financial statements. That is the next standard that we come across. After that, we are going for accounting standard 16, that is borrowing cost. What is this borrowing cost? What is this borrowing cost? Borrowing cost is nothing but when we are going to borrow money how much money we have to borrow. For that, what is the expenditure that we have to meet? That is nothing but borrowing cost. And in what way we have to show that cost in the financial statements? That is also very, very important, okay, from the management point of view. Without spending some amount, you cannot borrow. For, say for example, for documents, whatever it may be, the document that they seek. So for all these things, some expenditure they will come across, and that thing we will call that thing as borrowing cost. And schedule number 16, not a schedule, accounting standard 16, it will take into account what is the expenditure that we met, that we come across in order to borrow money from the people. Whether it may be from financial institutions or from banks, you have to spend some money, otherwise you won't get any borrowings, okay, from outside. And this accounting standard, it will look after that borrowing cost. Next comes the segment reporting. Segment reporting. This is very, very essential when we go for this. This is very, very essential when we go for this segment reporting. Okay, every stage we have to take that as a small part. When we take that as a small part, then that small part we can say that it is nothing but a segment. Right from the recording of transactions until the preparation of final accounts and financial statements, everything is a segment. And everywhere you have to report what you have done to your higher authorities. Thereby they will be satisfied and they can go further without any trouble. So this thing also you have to take into account. Segment reporting, that is discussed in accounting standard 17. Next, accounting standard 18, related party disclosures. You see, so many parties we will come across when we are doing a business. When we are doing a business, we will have to interact with so many parties. And who are the related parties? Who are the related parties? And what they want, you have to show them in a clear-cut manner and a complete manner. You should not hide anything with those people. For example, creditors for supply of the raw material, all these things. So there you have to show each and everything. This is the raw material that we have taken from you, and we have to pay this much amount. All these things, when you take that in a segment manner, that is a small portion, then automatically you can show them clearly without any hiding. So that is nothing but, okay, related parties. Okay, related parties disclosures. That is accounting standard 18. Now 19, accounting standard 19, leases. This is very, very important. Okay, this is very, very important. You see, when any person, when he cannot able to look after himself, all the activities, and when he want to take the fruits without any strain and pain, then what he will do is, he will give the company or he will give the organization on lease. And before going to lease, they will come to an agreement, and that agreement will call that thing as a lease agreement. And the person who is taking the lease will call him as leaser, and the person who is giving the lease will call him as leasee. The leaser, he will take the property or the asset or whatever it may be, has to take from the leasee for a span of period. It may be 10 years, or it may be 12 years, it may be 13 years, or it may be 15 years, or it may be for 20 years. But whatever it may be, he has to mention in the lease agreement agreeing to pay some amount to the leasee. And in small undertakings, we'll call them as royalties. and in big organizations we'll call that thing as lease rent. So accounts dealing with lease, they are also very, very important. For example, when you are having an agricultural land, when you cannot be in a position to look after that, when you cannot be in a position to cultivate or do the agricultural work, then you have to give the land to a person, to a farmer who is nearby for lease. And that person, he will do agriculture and he will return the commodities as well as some amount which was agreed between the leaser and leasee. There you have to go for lease agreement. And in lease accounts, you have to remember one important thing. No leasee will give lease, okay, up to 11 years. Okay, up to 11 years only he can give. On 11th year, he has to go for a new agreement. This is the thing that we have to understand. Okay, you can go for 99 years, you can go for anything, any year, number of years. But thing is, when you cross 11 years of time, you have to go for a new agreement, new lease agreement in the place of old lease agreement. This is about this leases. And accounting standard 19, it will look after the leases. Next, accounting standards 20, EPS, earnings per share. So what is this earnings per share? This is very, very important in any organizations, especially in companies. EPS, earnings per share. A company will earn money, but how much it is earning, we have to take into account, and how many shareholders are there in the company. Here when we go for shareholders, two types of shareholders will come: preference shareholders and equity shareholders. Whether we have to take preference shareholders into account or equity shareholders into account, that is the main question that we come across. Here, when we go for that question, we have to give much importance for equity shareholders rather than preference shareholders. Because preference shareholders, they won't stay for a long period of time. As and when they want, they'll go away from the company. But equity shareholders, they'll stay until the company goes into liquidation. So, how many equity shares are there in the company, and how much earnings that we got, and what is the earnings per share, we have to take into account, because this is essential, very, very essential when we go for accounting ratios. In accounting ratios, you'll come across the EPS ratio. So earnings per share ratio. This is very, very important. And this accounting standard 20, it will look after that EPS. Next, accounting standard 21, consolidated final statements. This is very, 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 very important when we go for this holding companies. What is a holding company and what is a parent company? We can call holding company as well as subsidiary company as parent company and child company. In this, one company holds another company. That's why it is known as parent company, and the company which was holded, we'll call that thing as child company. And when we come across this holding company, when one company, when it purchases more than 51% of shares of another company, automatically the previous company is known as holding company and the second company is known as subsidiary company. Not only this, when it appoints major number of directors of another company, if one company appoints more number of directors in another company, then also it will become a holding company and the other company will become a subsidiary company. And when we go for financial statements, we have to prepare the consolidated financial statements. That is consolidated profit and loss account and consolidated balance sheet. There you have to understand that we have to take into account not only subsidiary company but also minority shareholders. We have to take into account how much percentage that we have to give for minority shareholders and how much percentage we have to give for subsidiary companies. There they will prepare consolidated financial statements, and this accounting standard will look after that preparation of consolidated final accounts. Then comes accounting AS22, accounting for taxes on income. This is very, very important. The government will get money by tax. In the same way, it will charge taxes from the companies, and it will take the taxes in the form of direct taxes and in the form of indirect taxes. So getting from this taxes, from the companies or from the incomes of the companies and businesses. This is also very, very important, and I'm stopping here, and remaining things we'll discuss in next. Whatever it may be, the comments that we connect that you want to give, you please give in the form of comments. Any doubts in the form of comments, and don't forget to subscribe. First of all, read this, understand this, and if you like this, you please subscribe. Thank you very much.